All right, folks, so check it out. We know about tax write-offs, but we also know about tax strategies. Today, we're going to talk about the 5 ways to significantly lower your taxes in 2024. It's a must. Grab that pen, take it back, and rewind it twice because you're going to walk away with some really good information. So, folks, let's talk about the updates in 2024. And remember, tax law has changed about 30, 40 times since the 1960s. So whatever I'm going to talk about today, look back in time and you'll see that it's going to change anyway. But according to that, your federal income tax bracket helps determine how much money you're going to pay in taxes for any given year. You always got to be careful what kind of strategy you do now because that may not work later on in the future. I.T cross along the way. With that being said and done, excluding the standard deduction or any itemized tax deduction. For 2024, the standard tax deduction for single filers has been raised to $14,600, a $750 increase from 2023. For those married filing jointly, the standard deduction has been raised to $29,200, up $1,500 from the previous year. This is like vomit divided by diarrhea. I understand. I get it. Bottom line is this. Had a household 2023, $20,800, 2024, $21,900. The point is you got to get with the right people that can not just give you a write-off. You got to get with the right people that aren't going to just look at the dead bodies on a battlefield and be historians. You need to create tax strategies and get the write-offs off and be able to move on and make good decisions with your money, time, freedom. What are the best ways to save? I'm going to give you 5 of them. And stay tuned to the end because one of them is a goodie that's going to put money back in your pocket where it belongs. Number 1 of 5, a 401k or traditional IRA. Let's get into it. One of the easiest ways to reduce your taxable income is to contribute to a pre-tax retirement account, such as an employee-sponsored 401k plan or traditional IRA. Your money grows tax-deferred, though you will have to pay income tax on the funds when you withdraw it in retirement. In 2024, this is important, folks, the contribution limit on or for a 401k is $23,000, with an additional $7,500 available for those over 50. The total contribution limit for a traditional Roth IRA is $7,000 a year, with an additional $1,000 available for those over 50. So check it out. In a normal 401k, if you're over 50, they can't wait to hurt you in taxes even more because they let you put in $7,500. And remember, in a traditional or a Roth, you get that $7,000, and they give you the $1,000 increase. These are important little distinctions to understand because once you know exactly what your money is going to look like, not on the front 9, which is putting money into the 401k IRA, but on the back 9, what are the tax consequences of those very products later on in life, and you need to be aware of it. Do a checkup from the neck up. With that being said, here's a pro tip. Don't get overtaxed by keeping your money in the wrong account, and we're going to get into that. 2 of 5, Employee Stock Purchasing Program. An Employee Stock Purchase Plan, ESPP, allows you to use after-tax dollars from your paycheck toward purchasing shares of your company, typically at a discount on the price, usually around 15%. While employees can choose to sell immediately after purchase or at a later date, they're rewarded for holding on to their shares for at least 1 year. Selling later means, guess what? Long-term capital gains, which is much different than short-term capital gains. It's important that you understand this game because, listen, if you're going to even hold this stuff, instead of even selling it, you can leverage it and use that money for other investment opportunities, have those opportunities pay back the money you leverage from these very stock purchase plan strategies. More to come on that, but it's something to think about as you go through the process. And always remember, ISPELL, very WELL, so Alka TELL. Number 3, Health Savings Account, HSA, allows individuals with high deductible health plans to save for upcoming medical expenses. HSAs offer a triple tax advantage. I love these since funds go in tax-free or tax deductible if you opened up your own account, can grow tax-free by investing the balance, and can be withdrawn tax-free if used for qualifying medical expenses like deductibles, co-pays, or co-insurance. There's so many illnesses out there, you'll be safe with this. Plus, any remaining balance on your HSA will roll over year to year. So this is not use it to lose it. This is the opposite. And at the end of the day, what's important to understand is how you take these different products and these different pieces on your financial mosaic and how to have them work better for you and not for the government. 4 or 5, student loan interest. The interest paid on student loans can be a simple deductible on a taxable income. For 2024, if your modified adjusted gross income is less than $75,000 or $150,000 if filing jointly, you could deduct up to $2,500. If you earn above that, you could deduct a prorated amount. The cutoff for claiming a deduction is about $90,000 for single filers and $180,000 for joint filers. Payments and interest on federal student loans were frozen March of 2020 until October 2023. If you paid interest between October and December 2023, you could deduct it from your taxable income in 2024. So we're still feeling the effects of COVID, obviously. There's a lot of little mini games that are happening in that space, so you want to be able to understand what that is and be able to get money back in your pocket where it belongs. Number 5 of 5, guess what, folks? There it is. Purchase, I know you didn't guess this, purchase life insurance. Whole life insurance can avoid taxes by building cash value. Your cash value savings grows tax deferred, so you don't owe taxes with your savings. In comparison, if you save through a savings account at a bank or a CD, you'd owe tax on the interest each year. If you borrow your whole life insurance cash value through a loan, you could take the money out without owing any taxes, put that money to work. Even if you did in commercial real estate, you get another write-off, but put that money to work in other opportunities and allow those opportunities to pay back your policy itself. Now, later on in life, when you want to take distributions, it's up to basis. In other words, how much you put in. And then to maintain that tax-free status, you would borrow from the policy on the distribution side in retirement and still maintain the tax advantages that we talk about. Remember, tax advantages, not tax write-off. We want to make sure that all that's in our favor, so we put ourselves in a position to continuously prosper and make sure that next generation, even though they'll be spoiled by our success, we at least give them money that's tax efficient. All right, folks, thank you for staying until the end. I hope you got a lot of value out of this video. There was a lot of information there. We're not going to charge you for a sit-down. If you want to open up a life insurance account today to access your money tax-free, go ahead, click the link below. One of the members here at Epic will sit down with you and take you through our success process. And once again, thanks for being part of the community. Continue to like and follow and hit that subscribe button.